Our rule right now is if delinquency is over 6% of gross potential rent, we're passing on the deal. Unless it really has a story and there's really, a good reason why that delinquency is high and we believe that we're able to get it down. But we'd rather take over on a property where delinquency is controlled. We know we have residents that are going to be able to afford and pay their rent, and we're not going to have to go through the battle of evicting residents. Welcome back to the Keeping It Real Estate Show. I'm Mike Roeder, and today we're going to dive into some of the biggest changes in how we're underwriting multifamily deals today versus what we were doing a few years ago. The market has changed dramatically. Inflation has changed significantly. Interest rates have changed significantly. Economic conditions are different. And all of those factors have forced us and most other investors out there to evolve on how we're approaching underwriting and how we're fine-tuning our underwriting when we're looking at a new deal to really mitigate the risks that are out there in this atmosphere. So let's get into some of the key areas that have shifted, and we'll go through some reasons why those areas have shifted as well. So first up, capital expenditures or CapEx. We've seen some major adjustments, and this is mainly due to inflation. So 3 years ago, it was really commonplace to use an average CapEx number of maybe around $5,000 to $7,000 per unit for renovations. So that would take care of the interior unit renovations, that would take care of your exterior deferred maintenance, maybe some exterior projects where you're freshening up the exterior paint, taking care of the parking lot, any items like that. And that's really a back of the napkin type of number. So you're going to dive in more. It depends on how or what condition the asset is in. It depends on your due diligence if that number goes up and down. But that was generally what we were using and what we were seeing on the assets that we were acquiring. Fast forward to today, construction costs have skyrocketed. You have labor that's went up significantly. You have materials, those have went up significantly as well. Basically, anything surrounding the construction industry has went up quite considerably. And so that $5,000 per unit simply doesn't cut it anymore. When you're looking at a standard upgrade, instead of using, maybe $4,000 or $5,000 a unit, you're probably going to bump that up to $7,000 or $8,000 per unit. Again, it depends on what type of upgrade you're looking for. But let's say you're replacing the appliances and you're putting in some black or stainless steel appliances. You're putting on a new Formica countertop, some vinyl flooring, some painted cabinetry, a lighting package. A lot of times we're in that $6,000 to $8,000 range for those items. Now, if you're going with a premium upgrade, before you might have been at $7,000, $8,000. And that would be stainless steel appliances, quartz or granite countertops, stylish backsplash, new cabinetry. Again, before you might be at $7,000 or $8,000. Now we're likely budgeting $10,000 to $12,000 for a full upgrade, more of a premium upgrade like that. So in reality, costs have increased across the board, and you just need to plan for these numbers up front. Now, a lot of times when you're doing these interior upgrades, because the properties that you take on or that you're investing in are already stabilized, it might take a year or two to get through all of those unit upgrades. Now, what does that mean? Well, if inflation is 3%, or if it's 5% or 10%, that means that you have to factor some additional inflation into your numbers because it's going to take time to get through your value add plan. So make sure you're taking that into consideration when you're looking at investing into a new project, whether it be your own project or a passive investment. Number two, the second thing that we've changed significantly is our debt strategy. So we've been focused very heavily on buying stabilized multifamily assets with fixed rate debt. And 3 years ago, there was a few deals where we used bridge to agency strategy. So basically you put a short-term floating rate bridge loan in place and you implement your value add procedure, you bump the NOI up, and then you refinance into long-term agency debt that has a fixed rate, typically 5, 7, 10, or 12-year term on those. Well, with the volatility of interest rates, that's caused a lot of pain in the industry. And, back 3 years ago, that was the bulk of the deals that were getting done were using that bridge debt. Well, fast forward to today, we're focused on fixed rate loans that really allow us a longer runway. It gives us, a good 7 to 10 years to implement our business plan, stabilize the asset, to really drive the value of the property up. and have that runway to do so where we're not, getting in hot water. When you have a short-term loan, 1 year, 2 year, 3 year term, maybe 5 year if you have a couple of extensions, 5 years goes pretty quick in the multifamily industry. And if the economy dips, if the multifamily industry dips, that can be a really tough situation to be in. It's also worth noting that agencies like Fannie Mae, Freddie Mac, they typically won't lend on assets that don't meet their criteria, such as a minimum occupancy. So typically they want to see the property being 90% occupied for the last 90 days. That's very, very important. And if it doesn't hit those metrics, typically they're not going to fund or they're not going to lend on those types of deals. So we've really been focused on acquiring stabilized assets where they're going to cash flow day one. They're able to cover the debt, all the expenses, the CapEx, right when we step into the asset. And then we're able to implement our business strategy, our value add strategy, increase the NOI, but it's not something where there's a ton of distress and we're taking over and we're having to ramp up the occupancy over time. In that type of situation, you're likely going to go with a bridge or a bank loan, which in our opinion is typically a little bit more risky because it's either variable rate debt where the interest rate might go up and down, or it's short-term debt. Number three, the third thing that we have seen a big adjustment in and that we've been adjusting on the front end is delinquency. It's something that we're watching very closely, especially in certain markets, and particularly in C-class properties. With the reduction of government stimulus programs over the last couple of years, residents having to deal with high inflation as well over the last couple of years, delinquency has increased a decent amount really across the nation, regardless of what market or submarket you're in. Now, depending upon the asset, it's going to be a different number. An A-class asset, a lot of times you're not going to have as much delinquency. A B-class, a little more. C-class, a little more. And then if you have a D-class in a really rundown area, a lot of times that's going to be your highest delinquency type of property. Right now, it's not uncommon to see delinquency over 6% of gross potential rent, especially with those, lower demographic areas. If you're purchasing those types of areas, rewind 3 years ago, a lot of times we would factor in about 3% for delinquency. Our rule right now is if delinquency is over 6% of gross potential rent, we're passing on the deal. Unless it really has a story and there's really, a good reason why that delinquency is high and we believe that we're able to get it down. But we'd rather take over on a property where delinquency is controlled. We know we have residents that are going to be able to afford and pay their rent, and we're not going to have to go through the battle of evicting residents. It's also critical that we get our hands on a recent delinquency report. So when we're taking a look at a new asset, or if you're ever taking a look at a new asset, whether it be passive or active, make sure to get your hands on a full delinquency report before you put the property under contract, because you want to understand exactly how much rent is outstanding for the current month, how much is outstanding that's over 30 days, over 60 days. The longer, the period that outstanding rent is for, the less likely chance that you're going to get those funds back. The other cool thing is there are some new tools that allow us and other investors to analyze income and spending habits, really down to the property level. So we're highly tuned into the rent to income ratio. We're highly tuned into spending habits, as well as residents' likelihood to move apartments or buy a home. So these are all reports that you can run or that you can pay for, and it really shows the residents' propensity to pay their actual rent when it's due. But one of the best factors that you can take a look at is what is the current property achieving, and then also the comps around it. If you can have those discussions with your competitor properties, which a lot of times they will share information if you go in there and let them know what you're doing, or the general partner that's putting together the deal, they should be able to go and have those conversations and understand what the delinquency is like in that region. So again, very important piece of the puzzle. It's increased over time, partially due to inflation and partially because of the stimulus going away. And, it was a significant portion of a lot of people's rent when that was happening. Number 4, higher below the line expenses. So the costs associated with maintaining and repairing properties, especially older properties with aging infrastructure, have risen substantially. So for example, you have a 1960s property with galvanized steel plumbing or an outdated electrical system. it's often going to require much more significant capital along the hold period to keep that asset up, keep it functioning, keep the residents happy. Whereas if you have a product that was built in the 90s, there's typically, copper or PVC plumbing, the electrical's all up to date, so you're going to have substantially lower below the line CapEx as you go through the hold. Now, there's a difference in between your budgeted CapEx for the improvements and your CapEx after your improvements. So your CapEx for the improvements, that's something that you raise upfront, or the general partner should be, bringing to the table, or possibly getting financed by their lender. And that's taking care of the deferred maintenance. It's taking care of the unit turns. It's taking care of the upgrades, maybe some amenity increases or additions to the amenities. The other aspect is below the line CapEx items. So this would be, maybe you need to replace a roof, or you need to do a parking lot overlay, or you need to replace a boiler, after a couple of years of ownership. And many times those will go below the line. So that means below the net operating income line, but it's still cash that's going out the door. And what a lot of owners used to budget would be, somewhere in between $250 to $500 per unit per year. And typically that would be sufficient. Well, with inflation ramping up, what we're seeing throughout our portfolio and what we're hearing from other owners is it's pretty standard for older properties to be, somewhere in that $1,000 to $2,000 per unit per year for those bigger expense items that are just going to come up. Now, if you have a newer property, it's likely going to be a decent amount below that. So just understand that you're going to need some additional dollars above and beyond your normal expenses as you hold an asset, or as you invest into a passive asset, and make sure that those numbers or those funds are accounted for, and that that's not being paid out of cash flow. The number 5 thing that we've really seen a big adjustment on is higher payroll to attract talent on the property. So your on-site team is one of the most important components of a successful deal. Your on-site manager, your leasing agent, your maintenance tech, your porter, very, very important to the success of the property. If you don't have a great team on the asset, your asset is going to suffer. Now, with inflation and with wages going up over the last few years, there has been a significant rise in payroll costs, and this affects your construction costs, so your CapEx, but it also affects your direct payroll on the asset. So one thing that we do is we like to budget above and beyond what our on-site management team thinks we're going to need. So if they think we need $70,000, per employee, we're probably going to bump that up to $75,000 or $80,000, just so we have a little bit of extra wiggle room to attract some really, really good talent on that property, because we know paying that little bit of extra funds or that little bit extra payroll, it's going to make so much sense, and it's going to pay us 10x if we can get a great team member in place. Number 6, the last thing that we're seeing a big fluctuation or a big difference on is the reversion cap rate. So if you look back 3 years ago, it was pretty commonplace to have a cap rate on the sale, that might be 50 or 75 basis points above what you're buying. So you might buy at let's say a 4.5 cap, and then you might be projecting an exit at a 5 or a 5.25% reversion cap rate. Things have really flipped. So because the Fed is expected to cut interest rates moving forward, 2025, 2026, to some extent, it's really the consensus that with these rate cuts, cap rates will compress. So that means that the value of multifamily assets and other commercial real estate is going to go up as these interest rates come down. Now, it's going to be a little bit of a roller coaster, but that's the expected environment as we continue to go throughout the next few years. So a lot of times, if, let's say we buy or acquiring a property for a 6% cap rate, we might be projecting a 5.5% reversion cap rate, because we're expecting cap rates to actually decrease over the next handful of years. Now, we don't just guess on that number. We're using industry reports. We're using data on what other properties are trading for in the market, recent sales. All of that information is critical to try and mitigate risk and make sure that you're choosing the best reversion cap rate possible, or the most likely reversion cap rate. So all those pieces are really critical. And then the one other thing that I wanted to mention is the expense growth. So just your general expense growth from year to year. What we were doing a few years ago is we'd factor in around a 2% amount of inflation for expenses. So that would be all of your expenses combined, your payroll, your utilities, your contract services, your admin. So general admin, your marketing, your franchise tax, your unit turns, all of that would go up by 2% per year. Fast forward to today, we're using 3% or higher. And there's a couple of different factors that weigh into that. So first off, property taxes and insurance. Both of those pieces have risen really sharply over the last few years. So we want to make sure that we have a very close eye on that, and we want to make sure that we're getting experts to help us out with that guidance. So that way we can properly factor in the inflation that we expect to see with those expense line items. The other piece would be all the other expenses. And a lot of times we're factoring around a 3% increase for those items. Utilities would be the one item where you might want to factor in a higher percentage increase each year. So talk to your management company about that. Talk to your energy provider, your energy consultant, talk to your tax consultant, talk to your insurance consultant. All of those experts need to weigh in on those items because those are massive expenses that are going to hit your NOI. So in recap, the biggest challenges and changes in our underwriting today versus 3 years ago are CapEx budgets. They're significantly higher due to inflation. Number two, we're focused on fixed rate debt to mitigate risk. Number three, delinquency is up in certain C-class areas and across the nation. So we're leveraging new data and tools to assess income feasibility and factoring in higher delinquency rates in certain submarkets. Again, you can use industry reports for that, and make sure that you're tuning in to the property financials as well when you're first investing into a project. Number four, replacement reserves are higher, and this is to account for major future repairs during the hold period. Again, that rolls back to inflation. Payroll costs are up due to wage growth, inflation, and because A-player team members are really worth it. And then number six, reversion cap rates are lower than going in cap rates given future rate cuts that are forecasted out by the Fed. And then finally, the final item that we talked about was operating expenses. We're increasing at 3% or higher per year compared to the 2% that we used to be at. So these are some key adjustments to adapting to today's market, ensuring that we're making smart, sustainable investment decisions. Hope this helped you. If you found today's episode valuable, make sure to subscribe to Keeping It Real Estate and share this episode with a friend or family member. We would truly appreciate it. Until next time, we'll see you soon.